Good morning, everybody. Welcome to the Game Plan. My name is Gareth Soloway here, Chief Market Strategist at VerifiedInvesting.com. So we have a jobs report that just hit minutes ago. We did see a lighter jobs report, meaning lower amounts of hiring in the month of January. However, the kicker is that we saw hourly earnings going up. And so this kind of threw the market for a curveball because the market was craving a lower jobs number just by a little bit, which is what it came in at. But then it didn't expect higher hourly earnings, which are inflationary. We'll get to that number in just a second. But overall, we have earnings from Amazon. We have other companies making big moves on earnings, plus the jobs report. Let's get right into the action. Follow me over to the big board here, and let's take a look. So first off, let's go over the jobs report. Right here, we have 143,000 jobs is what the number came in at. 163,000 is what the forecast was. And a little dollar sign there, we can ignore that. But the point being is this is just a little bit lighter than anticipated. That's what we would call a Goldilocks number, meaning it's just where the market wanted. If this number came in right here, let's say at 80,000 or 50,000, the markets would start to fret and say, oh my goodness, we're sliding into a recession really quickly. It didn't. It came in 20,000 lighter than anticipated or so, and that, my friends, is a positive because generally that number, and I say generally, that number would drive yields to the downside, right? A little bit weaker maybe means the Fed can maneuver more. That's good. But wait, there's more. Hourly earnings here, right? We have hourly earnings surprising and going up. That is not good. So we have hourly earnings right here up 0.5%. Forecast had been for 0.3%, and that's a problem. Now, interestingly enough, first of all, look at this candle. This is the candle right here where that jobs report came out. You went as high as here and as low as here because the market was really caught off guard by which direction. Was this overall positive? Was it overall negative? Was it neutral? What do we make from this, right? A lower jobs report, but a higher number for hourly earnings. And so you can see the markets right now are trickling up a little bit, so we are net slightly green on the morning session as we get into the action here today just before the open. Just going to the daily chart of the S&P. I've talked about this. I want to go over it again today. I'm watching like a hawk this high pivot right here, right? So right through here, we're watching to see, do we test this level on the SPY, the S&P 500, at around 610 or so? If we do test it, do we break above it and confirm? If we do, we know the probability is we'll head up to this trend line here, okay, this upper trend line up in this range. All right, if it gets rejected or doesn't get there and we come down, this becomes your big support line. This line actually goes back a long, long way as well. So we're very close to this upper line. We've attacked it twice before this time, 1 and 2. The more you attack a line, the more potentially you could break. The weaker that line becomes. Granted, we haven't hit it yet, so we have to see where the markets go today on a Friday into a weekend. But let's be watching this level really, really closely. All right. So that's what we have on the S&P. I do want to show the 10-year yield of all days. We always want to look here and look at yields here. Yields are actually going higher. And so this is really interesting because generally when yields go up, the market sells off. But we did get a weaker jobs report, which means that the economy might be weakening a little, but then people are still getting paid more money. If we go to our daily chart, we can see, look at this, guys. So this to me still tells me yields are likely going to turn down. We've broken below this white trend line here. All right, that's a breakdown, granted unconfirmed breakdown. If we rally back, this will now be resistance. It'll be minor resistance, but still resistance. If I had to game this out, my guess again is we move back up into this level, and then we see the next leg lower, which probably means the jobs will continue to become weaker and weaker. And I think the market is thinking that even though hourly earnings were up, they think that if the amount of jobs or hiring gets weaker and weaker, eventually hourly earnings will stop going up and maybe even go down. And I think that's probably why we're seeing the markets inch up a little bit, at least in early trading, but it's still very early in the day. All right, the US dollar here, guys, we can see the US dollar chopped crazy action because it was trying to digest a good and a bad number on the jobs report, eventually moving up, now starting to move down. If we go to the daily chart, it still has a untriggered head and shoulder pattern. Remember, once it triggers, or if it triggers, that's where you start expecting a bigger move to the downside. Again, to trigger a head and shoulders, the neckline, which is the armpit here to here, that level must have a daily close below. We have not done that yet. So yes, it's a pattern, but it is an untriggered pattern via a head and shoulders. All right. So again, lots to look at this morning. I just want to flip over to gold. We don't usually do gold until later, but because of what we are seeing in the dollar and so on, we want to take a look at gold. And you can see, again, gold today is not doing much. It was up initially, and now it's coming back in. I would not be surprised to see a retrace on gold back here, but this would be a major technical support at around 27.90. And I still think by year end, if not sooner, we're headed towards 3,000. And just because I did gold, we should do Bitcoin real quick. Bitcoin is pushing up a little bit. We can see initially on the 10-minute that initially Bitcoin kind of chopped on that jobs report, now is catching a bid. And we could say, okay, well, why is Bitcoin catching a bid? Well, because the stock market's inching up as well, and Bitcoin, again, is rallying. Now, on the crypto side, as long as we're talking crypto, let's talk some of these charts. I was just going over this with the Trader's Edge crypto live day trading session we just held, which is part of Smart Money crypto now. And what we could see here is this is a very interesting pattern here, right? So I want to just show you this chart setup. We're going to actually remove all lines. One of the chart setups here is, and let me go over to the big board for this. This is Polkadot. Now, again, almost all the altcoins, and maybe not Ethereum. Actually, Ethereum does have a bottoming tail as well. But this pattern formation right here, see that? That is what's called a bottoming tail. And when it occurs at the lows of recent history on the chart, it is a reversal bullish signal. So this was happened basically, I think it was either Monday, I think it was Monday. Monday we had that big flush in reversal, and it came at the low end of the chart. And so what this does is when you get a bottoming tail, I'll draw it in here, right? So let's do it down here. So it's a long tail with a kind of a small body at the high end, just like there, right? And what usually happens is what we call a retrace of the top or the bottoming tail. And the retrace, so it's trading here, it likes to come back in like this, and then eventually it turns up. The idea being is it turns up like that. So that might be what we're starting to see here on the altcoins, is for them to catch a bid. Now, in all fairness, most crypto hardcore enthusiasts would be like, all right, yay, it's going to go to all-time high. No. I mean, this is, again, when I analyze this stuff, understand this is short term. So we're talking like days to a week or two out of upside. And then you have to start looking and saying, okay, well, what's the big resistance if this plays out to the upside that we could get to? And I can go over this chart real quick, just since I'm on it. The one thing that I would just point out, here's the daily chart. Take the high right here and drag a trend line down. So what do we have right here, right? We can lower that even a little bit right there, right through this high, right through this high. So if we rally up, resistance is going to be at 570. That will be a big test. Now, it could break, but it also could get rejected. But that would be your first target price on Polkadot to the upside. And again, a lot of these other coins have these. I think Cardano has it. Let me take a look at Cardano. Yeah, Cardano bottoming tail right here, retrace, starting to turn back up. Cardano would have a lot of resistance around 90 cents. This low right through here, that would be big, and then upper range right in here. Okay, in any case, we'll get away from crypto now. As we talked about that, we got to look at Amazon coming down on the back of the earnings, right? So earnings came out yesterday after hours. They were a little bit weaker than expected in terms of their guidance, and that, again, we've seen that a lot from a lot of the companies here. They have these robust fourth quarter numbers, and then their projections, their guidance is a little on the lighter side. Now, in all fairness, Amazon's not doing much. It's down slightly. You can see here, initially it had this big fall before bouncing and chopping. It's only honestly down about $5-6 on the morning. That doesn't even get me out of bed in terms of looking for a level. Now, on the daily chart, you have a very clear upward trend line of resistance. That tells us resistance is at 242.75 to 243. And then if it did break below 226 and confirm, that would be the warning sign. Anything in here, like down what it is today, means no difference. There's no big thing in the trading of this stock. It's still in this upward wedge pattern. It's when it breaks here or it breaks here that alerts should go off in your head that a big move is coming. Affirm, big pop on this one. The reason I'm bringing up Affirm is, number one, it's up quite sizably, although it is fading. But remember, Affirm is a buy now, pay later company. And so I always raise this as an indicator for economic stress. When these companies do well, it's at the end of a business cycle when there's more and more people struggling. So instead of paying for an item just straight up, they say, you know what, I really want that, amazing new thing, but ultimately what I have to do here is I have to buy it in installments. And so the fact that, Affirm is doing so well, that actually could tell us that the consumer is struggling more and more. And I always say that these buy now, pay laters do great during this period, but then once everyone stops paying because they lost their job or we're in a recession, then these companies tend to crash. And you can see this historically in other business cycles. Now looking at this chart here, guys, we're at $70. We hit a high of around 73. If this stock continues up, where would that trend line or resistance be? This is hard to find, to be honest, because it is down so much still from those highs in 2021. There's a little pivot at around 83.50, this little high right here. But again, this is not that close at this point, but that would be a level I would watch. Now, Elf Beauty, I already annotated this chart out. Again, you can see right here, 58.20. If we look at the 10-minute chart, look at this drop here, guys, and you can see that trend line from the daily chart. But look at the drop on Elf Beauty, trading right now at 66.50. It is off of its lows of 64, but this one, again, their guidance was just not good. Now, this kind of piqued my interest. The company said, hey, listen, they did well in the fourth quarter, but in January, which we just got out of January, they said the reason we're lowering guidance is because we've seen a major shift of consumers stalling on their purchasing of products, all right? Now, again, is that company specific? Or is that a bigger trend, a bigger macro trend of the consumer? And the reason I bring this up is that you start to put the pieces of the puzzle together from a lot of these other companies that are saying things somewhat similar, lowering guidance. They're starting to see signs in January that maybe there's some stress or greater stress on the consumer. And again, you have to say, okay, does that mean later this year there could be something bigger on the horizon like a recession? We'll have to find out. But suffice it to say, going back to Elf Beauty, this level here, 58.20, would be a major technical support. Look at this right over here. There's a gap fill. There's a pivot high right there. If it does get there, that would be a very nice level. All right, next up, let's look at Skechers, falling this morning about 11%. Trading at 67. Daily chart was trending higher, gapped lower, now moved higher, and then here today. So if we look at this, my level that I'll be watching on Skechers, the initial day trading potential level, 63.70 right here, followed by additional gap fills right down here and double bottom right here. So again, really first level on this would be around 63.50. If we look at the stock, it's currently trading at around 67, but this stock tends to move a lot, so don't be surprised. You can see over here, it almost got down to that level. That will be an initial technical level of support. Cloudflare having another good robust rally on earnings. Excuse me. Overall, trading at 157 here. And again, it's had a big move up, but if I zoom out, look, it's still below its all-time highs from 2021. Again, in terms of a level on this, I don't know, man. There may be 170-ish. Let's see where it's trading again. Yeah, I mean, there might be a level in the 160, high 160s to 170. Again, when you have to go back so far on the chart, it does get a little trickier here. Actually, 165 to 170. Yep, that's the zone right there that I'll be looking at here. I know it's hard to see, just like it's hard to see for me even, but there's a little open here and a high of a tail right here, or a wick at 170 and a quarter. So somewhere, maybe for me to play it safer, and again, I'm just speaking for myself, right, is that as I'm a day trader, I will probably potentially be trading this today with the Apex Live day trading room. And I would say for me, I'll probably play it safer on a Friday. I hate taking a loss on a Friday, but I'll probably play a short at around a 170 Pierce. If it gets up there, I think the risk reward makes sense. If it doesn't, so be it. So be it. Okay? All right, so that was an interesting one there. Let's just go through a few other charts out there on the day. I did want to show you one setup here on APP, which is AppLovin. So AppLovin here, I want to show you this parallel here that I have, and I'm going to erase it and start from scratch. But the reason I bring this up is because it's kind of an interesting setup where you can kind of do a risk-reward assessment. Okay, so if we look at this, what type of pattern is this? And actually, I'll go annotate it on the big board here so we can kind of go over it a little bit more. So we have AppLovin. They have a software that's used in e-commerce, I believe, advertising stuff that's AI related, which is why it's had such a massive run. This was one of the best performers in 2024, by the way. But it did put in a high pivot right here, right? And it had this big sell-off, right? This big sell-off here. And then this pattern, as we all should know, is a long, long bear flag. All right, so the idea here is that saying, okay, well, let's just say we were interested in shorting this as a swing trade. What would our stop out be? What would our targets be? Well, on the chart, there's a massive gap fill right here, right? So that would be your ultimate downside target, which again is way down around 175. So that's actually, if it were to fall from here all the way down there, that's a 54% drop in the stock. Okay, so the reward looks good, but as a technician, you don't just want to say, oh, well, the reward looks good, so let me do a trade. You want to say, well, what's my risk? What's my downside for a potential move? And that's where you have to start saying, okay, well, where does the bear flag fail? Great question, right? Well, where does the bear flag fail? So to do that, we say, okay, bear flags fail if they take out this high on a daily closing basis. And so essentially, what's nice about this scenario is you have a nice bear flag, but even if it doesn't work out, and we know that in general, even if we have a great setup, there's still there's still 20, 30% chance that it fails, right? So you have to be ready for that possibility. If this price were to, let's say, trail up here and close above the topping tail or the top high, that would be the stop out. Now, what's cool about that is from current price, that's only about 10% higher. So the idea here is you start saying, okay, well, potentially have a 54% net gain to the downside if this works out with a 10% risk. Now, it's not really 10%, it's a little bit bigger potentially. The reason I say that is because it's a daily closing basis. So what if you rally up and then you close here? Right, so then you have to kind of factor that in. But the way I view it is 10 to 15%, right? So let's be fair, 10 to 15%. So you give yourself an extra 5% in case it closes above, like a decent amount above that level. The point being is, as a technician, this is the stuff you want to look for in the charts. You want to say, what's your risk? What's your reward? Does it make sense? Is the technical pattern intact? Is it a good pattern? What other factors do you have? Like, for instance, I would look at the RSI on this, see what the RSI is doing, and other things like that. So little tidbits like that, I think, is just an idea. The idea of me going through this is not necessarily that that any of us should necessarily trade it. This is more for educational purposes in terms of saying this is how you analyze. And the idea being is that I want you guys to be able to go to any chart and do the same, right? So we want to be able to employ these tactics across the board. All right, we'll go through a couple of these other charts here. Just looking at silver this morning. Silver again is attacking this potential level. 3 days in a row, it's hammered on this 32.25 level, which I gave you over a week ago as the big resistance level. Today is the fourth day it's above. The more it hits, the more chance it has to break through. So we'll keep our eye on that and see where it closes on silver. Let's go to oil real quick here. If we take a look at the oil chart, oil did close below this line. It has not confirmed yet, and right now oil is catching a small bid. I have no exposure to oil anymore in terms of any direct vehicle shorting it or on the long side. Natural gas here, if we take a look at nat gas, always a fun one. I don't mind it's down a little bit today. I want to see this pattern continue. So basically what we're looking for is kind of this bear flag. Ideally, I want to see it kind of creep up towards this area here, right? So down move, inside bar, and the short for me would be right when price, let's say price continues to chop right into this 350, 360 area right here. That would give me a potential setup. Bear flag after it broke below this upsloping channel, retraces to the low end of the channel, which is the scene of the crime of the breakdown, and you could look to short into that, or I may look to short into that. Okay, so that's really what I have for you guys today. Again, just to recap, we had a jobs number that was weaker than expected, but hourly earnings were stronger. Yields, last I checked, in fact, let's go to yields one more time. Yields are still up on the day on the back of that. And on the other side of the coin, the SPY, let's go and refresh that. SPY is up fractionally, very minimal upside on the SPY, but we are up a little bit on a Friday heading into the weekend. All right, thank you guys so much for a wonderful week here. Thank you guys for being supporters of Verified Investing and the technical data-driven data-driven analysis kind of aspect that really, in my opinion, is missing. It's what the institutions use. That's why they are so successful. They got the money to back them, and they use data, not emotion, to make decisions. My goal here is to bring that aspect from the institutions to you guys so that we're more on an even playing field with the institutional money, and we can make money in both bull markets and in bear markets. That's the important thing. Most retail investors lose in bear markets. You don't have to, and that's important. Have a great weekend, guys. Thanks so much. I'll see you soon. I'll see you next week.